Hi everyone, welcome back to my channel. This is my usual weekly technical analysis outlook videos in which I will comment on what I think will happen to some FX crosses and equities. I have another series running, the Financial Market series, that breaks down topics in the financial market in ways that are easy to understand. You can find the links in the description about these videos. As always, before I begin, I want to clarify that this is not a solicitation or recommendation to enter into long or short positions in the names that I will mention in this video, nor do I have existing positions in them. This is not financial advice, and if you're using this content as a guide to trade, you are doing so at your own risk. Alright, let's start. The first part of this video will be about reviews, and these are the names that I have covered in past videos, and I will do a quick review on each of them. Next, I will begin covering these names and review them in upcoming videos. I've put in timestamps, so please use it to skip to the names that interest you. I stayed bearish on the EURCHF in the video on the 8th of December and noted that the Ichimoku cloud has been rejecting advances, giving examples over here, as well as over here. Now let's examine the latest price action, and we can see that this remains true. The latest rebound was rejected by the Ichimoku cloud again and leading to a close below the 20-day simple moving average. So I will be staying bearish on the EURCHF, and the textbook target of the symmetrical triangle remains unchanged at 0.9069. I've not covered Eli Lilly since the video on the 8th of September, in which I said that it may be forming a double topped, a bearish pattern, and the completion will be via a close below the neckline at 747.55. Now, Eli Lilly completed this bearish pattern on the 15th of November and has undergone two phases that are common in chart patterns. First, which is the completion phase, and then the correction phase. I believe Eli Lilly is now in the bearish resumption phase. Downside is favored after price action closed below the 20-day simple moving average, and the textbook target of this bearish pattern is at 529.71. And I noted in the last video that there are two supports that may prevent Eli Lilly from excessive declines, firstly at 721.59 followed by 618. But in any case, I believe the bearish resumption phase has begun for Eli Lilly. I first covered Meta Platforms in a video on the 27th of October, in which I said that it may be forming a bearish pattern called a rising wedge after price action over here was rejected by the resistance trendline. I added that a bearish outlook can only be confirmed via a breakdown below the support trendline, and noted that Meta could just bounce higher for all we know, extending its trading within the range towards the vertex of this rising wedge. Now, last week and this week, we saw Meta first facing resistance at the same resistance trendline and getting rejected thereafter. So this could be the start of a gradual move lower to the support trendline, but again, there is no confirmation of a bearish outlook until there is a close below the support trendline. So keep watching this. I'm starting a new coverage on perhaps the most important chart that you will see in this video. The S&P 500 just completed a rising wedge, a bearish pattern, and the textbook target is at 5,364, around 10% drop from the point of breakdown. But take caution, there are three reasons why I think the next move is likely to be higher first before resuming the bearish trend. Now, number one, price action over here has just bounced off the Ichimoku cloud support, refusing to close within the Ichimoku cloud, so suggesting that there may be some upside bias going forward. Number two, in this bounce, it formed a bullish engulfing candlestick, which is a sign of a short-term upside going forward. Number three, I suspect that the S&P 500 may be forming another bearish chart pattern in this bounce. Hang on, just let me show you what this could turn out to be like. So there is a minor support around 5,854, and if if the S&P 500 bounces from here, it should be taken as a correction. Now, if the S&P 500 bounces from here but does not exceed the last high of 6,099.97 and it falls thereafter, then this will qualify for a head and shoulders top with a neckline to break down at 5,854, and this will again confirm that the S&P 500 is bearish. But then again, the textbook target of this head and shoulders top is around 5,600, which is still higher than the rising wedge of the 5,369. The next new coverage is on Ferrari. Interestingly, its ticker Ferrari is called RACE on both TradingView and Bloomberg. Price action development suggests the formation of a head and shoulders top, which is a bearish pattern, and it is nearing completion. So this bearish pattern will be complete if there is a close below the 404.6 neckline. The textbook target is at 352.6 if this happens, though I believe Ferrari may not fall to this level because there is a firm support at 373.3. Moving on to names that I will no longer be covering in future videos, I will start with the US 10-year government bond yield. The rising wedge over here that was completed on the 18th of November had a textbook target at 4.029, and the 10-year yield reached a low over here of around 4.1260, which is around 60% of the textbook target before rebounding thereafter. Now, with this latest rally breaking above the last high, I believe this bearish pattern should be considered invalid, and we should be looking for new chart patterns to determine the new outlook for the 10-year yield. For now, it is trading above the cloud. It has converged towards the upper Bollinger. All signs are pointing to further upside in the 10-year yield after a mild correction. Next, I will cease coverage on Brent. In a video on the 6th of October, I noted that it has completed a cup and handle bottom, a bullish pattern. The textbook target is at 81.76. Brent reached a high of here 80.9 on the 7th of October, close to 80% of the textbook target, but has not recovered ever since. Chart patterns usually generate strong impulses, and after corrections over here, generally resume its trend. In this case, Brent has not resumed its bullish trend, so I will deem this pattern to no longer be valid. I will also be ceasing coverage on Richemont. This name reached only a little over 50% of its target at 100.45, only falling to a low of 112.8 on the 23rd of September, and has since reversed to close above the Ichimoku cloud. Therefore, I deem this bearish pattern, this double top, to be no longer valid. Lastly, I will cease coverage on Skechers. The last video, I noted that Skechers may be forming a head and shoulders top, a bearish pattern, and price action needs to close below the neckline on a weekly basis, below 57.5. Eventually, Skechers did not complete this bearish pattern and has since bounced off the cloud support to rebound above the cloud and rebound above the height of the second shoulder, therefore invalidating this bearish pattern. That's the end of my sharing. I will give updates to these crosses and names only when there are meaningful development, and in the next video, it will highly likely be on new crosses and new names. If you like what I'm doing, please help me out by giving me a like. Please subscribe and hit the notification button for more videos like this.